Hey there guys, it's Module 10. And today what we're going to look at is we're going to look at lease accounting, pension accounting, and income tax accounting. And what we're going to look at today, we up until now we've been talking about ratios, and we're going to look at actual accounting today. And for you accounting majors, this is going to be very interesting because it'll give you a very different perspective on accounting. And for you non-accounting majors, it's going to be interesting because it's going to give you a perspective on accounting, which is a little unorthodox. It's not what you would normally get in an accounting class. Because what we're going to talk about is we're going to talk about how accounting can be misleading and how accounting can lead you to believe things that aren't necessarily true and how to get around that. And we're going to take what I call the sandbox approach. And what I mean by the sandbox approach is that we take what a company has done, which according to the auditors is in accordance with GAAP, generally accepted accounting principles. We're going to take what they've done and we're going to fool around with it a little bit. We're going to play with it. We're going to change things around to get something that's a little more representative of reality. So oftentimes when the company presents things according to GAAP, certain things might not be on the balance sheet that we think should be on the balance sheet, or certain expenses are recorded in ways that don't necessarily reflect how we think the expenses should actually be recorded. Companies have to follow GAAP. So they're going to do what they do. And oftentimes they're going to make judgment calls too. Just because companies follow GAAP doesn't necessarily mean that that's most representative of their results. And so what we could do is we could go into our sandbox and we can move everything around and we can try different things to see what would happen if we account for things a little differently. And oftentimes what we can do that way is we can get a better picture of reality in the sandbox than what the company is actually reporting on the financial statements. A great example of this is lease disclosures. With leases, a lease is specifically a contract to rent an asset, and many leases under the existing accounting for operating leases are expensed. It's a form of what's called off-balance sheet financing. In other words, companies have the ability to buy assets but to lease them instead of buying them, and therefore they don't have to put the asset on the balance sheet and they don't have to put the liabilities on their balance sheet either. And by avoiding putting liabilities on the balance sheet, this can be misleading, and we call it off-balance sheet financing. And so what we might want to do is we might want to take the balance sheet, go into our sandbox, and add the lease. Put the lease back on the balance sheet, take the off-balance sheet financing and put it back on the balance sheet and see what that does to the balance sheet. And we sometimes will get a very different picture of the company's performance and the company's financial leverage by going through this practice. And today we're going to talk about this in terms of leases, income tax accounting, and pension accounting. And these are all areas where financial accounting can be very confusing and misleading, and therefore it would make sense for us to go into the sandbox and change things around. So let me talk a little bit about leases and what they are. A lease is a contract between the owner of an asset and whoever is desiring to use that asset, the lessee. When you rent an apartment, you sign a lease. And this is a private contract between two willing parties, and it's governed by whatever the commercial law is, et cetera, et cetera. And they usually provide that the lessee has the right to use the asset during a certain term period. The lessee agrees to make payments to the lessor and to take care of that asset. And then at the end of the lease, either the title goes back to the title remains with the lessor still ends it, and the lessee has to return the asset to the lessor, or the lessee can buy the asset for a very low price, or the lessee can buy the asset for the market price. But usually there's some provision in the lease to what's going to happen at the end of the lease, what's going to happen to the asset. So the accounting for this has changed, and we're currently in a transition year. And this 2018 is the last year that we're using the existing accounting. And then starting in fiscal years 2019, calendar years 2019, companies are going to need to use new standards. So I'm going to go through two sets of standards, the existing standards and the new standards. And by the way, the new standards rectify most of the problems with the existing standard. So the FASB has adapted this new rule, and basically both the old and the new rule create three categories of leases: what's called capital leases, operating leases, and a third category called financing leases, which we're going to get into a little later on for a few minutes, but it's not a big deal, financing leases. Capital leases and operating leases. So under the old standard, a capital lease would be basically you bought the asset. So we call it a capital lease. It says on it it's a lease, and legally the lessee is leasing the asset from the lessor, is renting it, and may have to give it back. But we call it a capital lease because we say that constructively the lessee has bought the asset. It might be called a lease, but in reality, the lawyers call it a lease, but the substance of the transaction is that the lessee really bought the asset. And therefore, what we would do is we would calculate the value of the lease, and that would be an asset called lease asset. And it would also be a liability, lease liability. So even though it's a lease, we would say that constructively, you really bought the asset, and therefore you've got to put an asset on your books and you got to put a liability on your books. The asset is going to be amortized. It says here it's depreciated, it's really amortized. And the liability is amortized, paid off like any other debt. So you would amortize it based on the interest rates and so on, record interest expense and principal payments. And the value of the asset and the liability would be the present value of the lease payments. The operating lease under the old accounting would not go on the balance sheet at all. And therefore, it would simply, whatever payments you make are called a lease expense. So previously we've been talking about capitalizing versus expensing. And here's a case where if you have a capital lease, it's capitalized. And if it's an operating lease, it's going to be expensed and not recorded on the balance sheet at all. Now, the definition, how you determine whether it's a capital lease or operating lease, there's a very fine line between them. And we'll talk about that a little later on. So basically, if 75% of the lease payments, the present value of the lease payments, is equivalent to the value of the asset, if it's less than 75%, you would treat it as an operating lease. And when it's more than 75%, you would treat it as a capital lease. I had a client when I worked as a professional accountant, and they sold computer systems. And they gave each client a choice. You can either buy the system or you could lease it. And they had two forms. They had the white form and the yellow form. The white one was the capital lease, and the yellow form was the operating lease. So what the customer would say, well, we want to expense it. And so they would give them the operating lease form, which was yellow, and here, sign this. And if the customer said they wanted to capitalize it, they would give them the capital lease form, which was white, and they would sign that. And the actual cash flow difference was so minuscule it didn't make a difference at all. So we as accountants feel that if you have to make payments on a lease, and I should say as analysts, we feel that if you have to make payments on a lease, then you're not fooling anybody. It's an asset and a liability. And there's a fine line between them, so we might as well just capitalize everything. If you leave this off the balance sheet, then you're missing debt, and the company looks like it has less financial risk than it really has. And we definitely don't want to understate financial risk. So we're extremely concerned about operating leases as they're off-balance sheet financing items, and that they may understate a company's true financial risk. So here you can see the difference under the old standard. And under a capital lease, you would record an asset and a liability. Your expense would be depreciation, really amortization of the asset, and interest expense on the liability. And you make whatever payments you have on the lease contract. Now, if it's an operating lease, nothing goes on the balance sheet. No asset, no liability. And whatever payments you make, that's going to be rent expense. Cash flows would be whatever your payments are, again, on the lease contract. So cash flows are the same, and the fact is they could be, in substance, very, very similar, but the accounting for them can be radically different. And this can be misleading for analysts. And if you didn't take this class, you wouldn't know anything about this. So we're having fun today. Consequences would be if you classify an operating lease rather than a capital lease, then there are tremendous financial consequences for your financial statements. One thing, you're not recording any lease asset. So your balance sheet is missing assets, and that means your asset turnover looks higher, i.e. better, than it really is. Because your assets are being understated, and therefore your asset turnover will be overstated. Furthermore, there's no liability going on your balance sheet, so your financial leverage is going to look lower, i.e. less risky. So classifying leases as operating leases really does distort the balance sheet in a serious way. And so what we want to do, and doing that, by the way, the effect on return on equity is going to be similar, because your return on equity is generally going to be lower. It's going to be higher. So this will, again, give the appearance that the company is doing better. And the rent expense can vary back and forth between the two methods. So sometimes the net income is going to be higher, and sometimes the net income is going to be lower, depending on which method you're going to use. This will affect income. Now, if the company has a regular flow of operating leases that it's continuing to replenish, in other words, it finishes one lease and it starts another and another, it has almost no material effect on income. The main effect is going to be on the balance sheet. So this is very problematic. Managers like it, perhaps, because it makes the company appear to be less leveraged, and it makes it look like they're accomplishing more with their assets, because it looks like they have less assets. And the standard itself was what we called a bright line standard, in that if you met certain thresholds, you had to account it one way, or if you didn't meet the thresholds, then you had to account for it the other way. And it gave very little room for managers and accountants to use their judgment. So the existing standard was very problematic, and it's still in play right now, and it's going to be in effect through the end of 2018. The new rule changes this around, and it's going to force companies to put all leases on their balance sheet, regardless of whether they're classified as operating or financing leases, or capital leases, I should say. So they renamed the capital lease as what they call a finance lease. And basically, under the new standard now, the finance lease would be a situation, again, which is considered to be constructively buying the asset. And the term the new FASB statement uses is the lease transfers control to the lessee. And in effect, it's like purchasing the asset. Whereas with an operating lease, the lessee controls use of the asset, but not the asset itself. Now, that's a new definition, and I think we're going to see some interesting things as accountants learn to use it. It's somewhat confusing. But the operating lease, therefore, what might be operating versus capital under the old rules is a little different from what might be operating and financing under the new rules. And all leases are going to be capitalized from now on, whether it's operating or financing. And what the difference between operating and financing, excuse me, is, do you say bless you? It's kind of funny. You said bless you to a video. The classification affects how lease expense is determined and where it's going to appear on the income statement. So with a lease expense, all you have to do is amortize the cost of the asset. For a finance lease expense for operating lease. For a finance lease, on the other hand, you would still have to amortize the lease asset and then also record interest expense on the lease obligation. So the accounting for these is going to be slightly different. Now, how do you determine if it's operating versus financing under the new rules? And these are, by the way, very similar to the old rules, but they no longer use what we call bright lines. So under the old rules, for example, if the lease term was more than 75% of the life of the asset, then it's a capital lease. If it's less than 75%, then it's an operating lease. The new term is if it comprises a major part of the economic life, then it's financing. If it's not a major part, then it's operating. Now, there's a second test. If it meets any one of these four tests, then it's going to be finance. The second one is present value lease payments comprise substantially all the fair value of the lease asset. That's the new rule. The new rule was the old rule was just 90%. So if you're over 90% of the present value, if the present value exceeds 90% of the fair market value of the asset, then you had a capital lease. If it was less than 90%, then you had an operating lease. The new rule says substantially all, which is constructed to be around 90%. Lease transfers ownership, and that's not negotiable. If your lease says that the lessee gets the asset at the end of the lease, then you have a financing lease, and that was the same as with the old rules. And also, if the lessee has the option to purchase the asset for what was called a bargain price, like $1 or $100, and it's $1 million asset, at the end of the life of the asset, they can buy the asset for $100. That's called a bargain purchase. And that would mean that you have a finance lease. Under the old rules, it was called a capital lease, but it's the same basic rules. So any one of these four conditions would indicate, if any one of them is met, it would indicate that you have a financing lease under the new rules. The footnote disclosure here is very important because the footnote disclosure helps us to do what I'm going to call constructive capitalization. So lease disclosures provide information concerning current and future payment obligations. And these are called contractual obligations. And what the company would need to do here is to list all of the payments that are due in the next 5 years and any payments that are going to be due after the 5 years. And they'll break them down into different kinds of leases. Especially, they have to break them down into capital versus operating leases. So here you can see a footnote disclosure for Southwest Airlines, and one column is capital leases, the next column is operating leases. Subleases would be leases to other lessees. In other words, they lease the asset, they lease certain assets from a lessor, and then they're the lessor, they lease them out. It's like subleasing an apartment. And they offset them. But basically you can see here the difference that most of their leases are operating leases, and therefore they don't go on Southwest Airlines' balance sheet. So what we're interested in doing is, especially under the old standards, the new standards, it doesn't make a big difference because the companies have to capitalize their leases no matter which way it's categorized. Just how you do the calculation is slightly different. But under the old rules, which are still in place now, companies have to companies have the option, or if they meet certain standards, they can have an operating lease that doesn't go on the balance sheet. What we want to do is we want to see what would happen, go into the sandbox and see what would happen if in fact we capitalize this lease. So what we're going to do is we're going to capitalize the operating leases with a process called constructive capitalization, and we're going to figure out in our sandbox what would have happened if we had put these leases on the balance sheet. And if you don't do this, then you're going to understate your operating profit margin, you're going to overstate your asset turnover, and you're going to understate your financial leverage. This can have a huge effect on your balance sheet. And it can really throw your numbers off. If you do it right, on the other hand, it gives you an advantage over other people, and you're going to come up with a more accurate analysis for your company than other analysts, and perhaps a better recommendation. So the way we would do constructive capitalization, what I would call the sandbox, we play in the sandbox to reconstruct the balance sheet the way we would want it to appear, is we need to determine the discount rate, compute the present value of future lease payments, and then adjust the balance sheet. So let's look at Southwest Airlines for a moment. To determine the interest rate, the discount rate rather, the easiest thing to do, now some companies don't have enough information to do that, is to impute the implicit rate of return. So if the company tells you what the future payments are, and they tell you what the present value is, then you can construct what the implicit rate of return is. for example, here, Southwest tells you that the leases have a present value of $365. They tell you the first 5 years payments, as we saw up here, 45, 45, 44. And there's plus 209, and the present value is 356. So from that, you can figure out the implicit interest rate. The only thing is they don't tell you after 2020. So we could just assume that it's 45, 45, 44, and it's just going to go on till 44 until we run through the whole thing. So I'm going to do 44s for the next 4 years, and then I got another 33, and that comes up to the total 209. So if I have this series of cash flows here, and the present value is 365, then my internal rate of return, the implicit rate of return, is 3.94%. Now I look at it, I'm thinking it's kind of low, but that's what it is based on the information that we have here. So now what we can do is we can use that information to figure out the present value of the operating lease. So again, this was all based on the capital lease. We sort of figured it out this way. Now, if you don't have this information, then you need to figure out what a reasonable implicit rate would be. And one way to do that is look at the company's credit rating, look at how much money they borrow. The cost of borrowing money usually is going to be a pretty good measure. So if the company has issued bonds, what's the effective interest rate on the bonds? And that could be your implicit rate, your internal rate of return. So now I'm going to take that same figure, 3.94%, and figure the present value of the operating lease payments. Now again, we have the same problem with the operating lease payments. They only give us 5 years. And then they go thereafter is 961. So what we need to do here is we also need to stretch these out. And 1529, they did this in a more sophisticated way. I would do it the same way they did it here and just add them up, like just continue 307, 307, 307 for 5 years until you run out, until you fill up the full 1529, and then figure out the discount value of each at 3.94%. So they did something a little more sophisticated here, which is fine. And they get a present value of 3188. And again, you can either use this the way they're doing it, which is they're projecting this forward and they're treating it as an annuity, or you can just estimate 307, 307, 307, 307 all the way down till you cover the full 1529. And so now we know that 3188 is the present value of the operating lease payments. So what would happen to our balance sheet if we stuck another 3188 worth of assets and liabilities onto it? So here's our assets, liabilities, stockholders' equity, revenues, and income. And we're going to add this adjustment here of 3188. Sorry about that. And now we have a revised balance sheet, or sandbox. And this gives us kind of a better picture of what's going on with the company's financial leverage. Here you can see how the numbers change. Return on assets now. Asset turnover goes down from 0.93 to 0.81. Return on assets goes down from 10.2% to 8.9%. And financial leverage increases from 2.9 to 3.33. So those are all big differences. Now return on equity is the same because income is the same in this case. So return on equity is going to be the same. And that's not always the case, because what you'll see situations when you try this out where you need to record additional expenses. So it's not necessarily going to be the same. The composition, though, changes, because what's going to happen is return on assets is now decreasing rather, and asset turnover is decreasing while financial leverage is increasing. So in essence, the company is a little less profitable. It's a little less, the turnover, the use of the assets is a little less productive, and the financial leverage is a little higher. And if you're comparing different airlines, then you really have to do this for all the airlines, because you want to use accurate figures. And different airlines have different mixes of operating and capital leases, and so they're going to get different it's going to completely throw off your analysis. So to adjust the balance sheet, you're going to add the present value of the operating leases to your operating assets. And here what we're talking about now is we're talking about the book model where we're using operating versus non-operating. And this is really the way we want to do things. So what's interesting is that the assets are going to be operating assets, but the liabilities are going to be non-operating. And this is going to completely change our model. It's going to completely change the numbers in the model. For the income statement, we're going to have depreciation expense, which is operating. We're going to have interest expense, which is non-operating. And we're going to remove the rent expense, which is operating. It's only fair. If you're going to throw new expenses onto the income statement, you've got to take the old expenses off. So think about it. If you have an operating lease, you just have rent expense. If you're going to switch that and call it a capital lease, then you take the rent expense off and you put on instead depreciation expense and interest expense. So the rent expense is going to come out of operating expenses. The depreciation expense is going to get added to operating expenses, and the interest expense is going to be added to non-operating expenses because interest is a non-operating expense. So here's the whole analysis, and you could see here my net operating assets are being increased by $31.88, and my non-operating obligations liabilities is being increased by $31.88. My NOPAT and my effect on income, my non-operating expense is going to increase by 79. And they show here the calculation. You can see it also in the book for NOPAT. But you can see here that NOPAT is just being adjusted for 79. I think they have a situation where the rent expense and the depreciation is about the same. So what's going to happen is this is going to have a big effect on your various ratios. NOPM, net operating profit margin, increases from 11.3 to 11.7%. Net operating asset turnover decreases a lot from 2.65 to 1.86 because you're adding all these operating assets. Return on net operating assets is going to go down a lot from 29.8% to 21.7%. Return on equity will be the same, which is not always a given. And your non-operating return is going to go from negative 0.18%, which really doesn't make any sense, to 8%, which seems a little more reasonable. Financial leverage is the biggest deal. Financial leverage is going from 0.02 all the way up to 0.45, which seems a lot more reasonable. So this analysis is really going to help you to come up with a more accurate analysis of your company's real value. So capitalizing the operating leases is going to decrease return on net operating assets, and that's going to be offset by lower net operating asset turnover. In essence, what we're saying is the company is a little more profitable, but the turnover is lower because we realize that we have more assets than we thought. Financial leverage is going way up because we're recording all these liabilities. And operating leases, we see that financial leverage is suddenly much more important because the company has all these operating leases. It means more risk. So keep in mind what's happening here again. What's happening is that the company's accounting allows them to take advantage of something called off-balance sheet financing. And what we're doing is we're putting it back on the balance sheet. Now again, these are the old lease rules. These rules are going to change starting in 2019. But I still think the analysis is worth going through because there are many, many scenarios where you may want to fool around with the balance sheet a little bit, so to speak, play in the sandbox to get a better estimate of what the company is really worth.